Right. Good morning, good afternoon, or good evening to everyone who join us from around the world today. It is my pleasure welcome you to today's webinar, China's mid-year outlook, trade deals loading, consumption, and innovation locks in. Before we begin, I'd like to introduce my co-host for today's discussion, our Chief Investment Officer, Brandon Ahern. Brandon will be, joining me shortly after the introduction to offer his insights into the pivotal trade negotiation, shifts in the consumption trends happening in China, also the breakthrough in China's innovation landscape. We are grateful that you set aside the time in your busy schedule today to be part of this timely and important discussion of a Q2 review. As we reach to the midpoint of 2025, China's economic landscape is once again in the global spotlight. The past months has been headline-making trade negotiation signs of a stabilization in global markets and a surge of fresh innovations from China's tech and manufacturing sectors. Today, we'd like to unpack all these key trends that are happening in China and exploring what they mean, not just for China, but for investors globally, multinations and industry leaders everywhere. So our session will include a look back at China's domestic developments in dealing with the global uncertainties, high-stakes trade talks, and have shaped this year's market sentiments. We'll move on to examine the resiliency and transformations of China's domestic consumptions, analyzing the breakthrough in innovation, particularly or especially in AI and robotics. Before we dive in, just a few housekeeping notes here. We offer credits for today's session with CFP, CIMA, and CPD credits. Please email us at ce@KraneShares.com if you shall need a credit. Please also use the Q&A panel to submit your questions throughout today's presentation. We'll address as many questions as possible during this live discussion. You can also send in your questions to us at info@KraneShares.com. That's info@KraneShares.com. Thank you again for joining us, and let's get started to take a closer look at mid-year outlook. Before we start, I think many of you joined Brandon and I for many quarters now for these quarterly updates. Some of you may know the firm very well already. I would just briefly share a few statistics for those who joined us recently or newly to this webinar. We are headquarters in New York, known for offering innovative investment solutions. Our products are available both domestically in the United States and internationally through funds listed on New York Stock Exchange, NASDAQ, as well as UCITS ETF in London, Milan, and German exchange. We are committed to deliver industry-leading differentiating investment strategy for you and your clients. And we have three key pillars: China, climate, and alternative solutions to provide access for significant market trends. Again, thank you for joining our webinar today. We're going to take a look quickly for what happened this quarter. Obviously, we know this quarter opened up with a fresh U.S. tariff imposed on wide arrays of China's exports, sending ripple effect to global market. China obviously retaliated back with the export lessons, requirements for crucial rare, this and that. All this happened suddenly. The trade started talking in Geneva and in London. Subsequently, we see huge developments that China show a very strong wave of domestic policy to support its economy domestically. We see Q2, its GDP delivered above market expectation at 5.2%. What does all this mean, and how does China achieve all of this? You have to go back to the history in 1980s or 1990s when President Deng Xiaoping back then started to open this country to become an open economy, to reform the economy, to literally transform this country from the old China model of the industrial heavily rely on very agriculture, industry heavy sectors to grow the economy, to the new China. I know the term used very popular from last few years, until now, the new China now, I say, is an updated version of a new China, which is now including the internet sector, the e-commerce, which is absolutely dominant of 80% of China's domestic labor markets, offering 80% of the new job every year come to the market, is helped and offered by e-commerce market. Also with the aging population, when there's an issue, there's actually an investment opportunity, given China's the largest pharmaceutical and hospital investments in the whole world for many, many years in the history now. China has the most rising needs of healthcare needs in the industry, also the most fast-paced privatizing industry in healthcare. Obviously, consumer and consumer spending is a long-standing story for decades and decades to come. The reason I say that, this is the country with 1.4 billion people, that's over 800 to 900 million people in middle class. This is continue to increase as the country continue to urbanize its whole population from rural to city. Market expecting these trends to continue to happen to reach 80–90% urbanization rate. So China's consumer power not only stay intact, is expecting to continue to grow from here. Obviously, China plays a very heavy bets and heavy investments in environmental protection. If not to say they are the largest solar panel producer in the whole world today. They're probably the largest, electrical vehicle car maker in the whole world today, and also adoption in the whole world today. They produce, they use, they also sold in domestically. They fast forwarding with their commitments to deliver their commitment to protect the environment. As we say, when we look at China, how you invest, where you to invest, it is very important you invest in the right part of the curve that you should be investing. Not to say that other industries are not important to China's growth overall, but as an investor, you want to bet one, where's the policy support? Second, where's the trend evolving, happening? Third, where's the breakthrough, where the clients can access to the leading industry, leading corporates in the whole world landscape, not only just in China. We sincerely think in your portfolios, in your allocations to EM, to Asia, to China specifically on its own, it is very important that you are on the right curve of what we show on this page, which is a new China, e-commerce, innovation, and consumer sector as a whole. On the next page, this is also why and where we have embedded all these ideas and trends happening in China over the last decades and continue to be the truth and the focus on Chinese government's agenda. We designed and listed and capitalized all these themes and trends happening in China into our strategy to allow you to use all these strategy on this page as a toolkit to access this market solely on its own, on its domestic themes, on the themes that impacting the global, overall the other themes that need China's involvement and contribution to achieve the next decades of the investment goal. These are our funds. Many of them are also available in the UCITS strategy, which is a European ETF equivalent to what you see on this page. Are all the tickers for the US ETF. They are grouped in the three key pillars, also separated slightly with China focus and slightly global on the other hand. As for now, I've done my part of intro. I hope to set the scene for you to know what to expect in today's webinar. In the next page, Brandon will kick off to give you a broader update of what happened in the market. Here you go, Brandon.
Good, thanks, Xiaolin. Yeah, I think to prove our thesis, really the genesis of Jonathan Crane creating KraneShares was wanting to provide investors opportunities to the growth sectors within China's economy and capital markets, which were represented in broad indices like MSCI China or within bigger indices like MSCI Emerging Markets. So this hypothesis was create a suite of China-focused ETFs geared to these growth elements of China's economy and capital markets. And the question then is, how did that thesis play out? And so since the global financial crisis low back in March of 2009, the S&P 500 is up almost 1,200% in US dollars term, greatly outperforming non-US equities as defined by MSCI All Country World ex-US, which is up not even 400%, and greatly outpacing both MSCI Emerging Markets and MSCI China. The question then is, why is that? Well, it's our belief that it was due to the sector dysfunction that many non-US equity markets are dominated by value sectors, unlike the US market, which has become dominated by growth sectors. So to test our hypothesis of if we just solely focused on a growth sectors, growth stocks, could we have had success over this period of vast underperformance? And the answer is unequivocally yes. So what's a growth sector? Well, obviously technology. So over the last 16 years, when MSCI Emerging Markets only went up 307% versus that almost 1,200% by the S&P 500, MSCI Emerging Markets technology went up 1,483%. So just owning this one sector in emerging markets, you actually could have outperformed the S&P 500. But if you bought the big, broad, cheap EM beta bucket, you got just barely 300% because that bucket was dominated by slow, no-growth sectors like energy and financials. That thesis is even more true when we apply it to China. So MSCI China technology, since the GFC low, went up 3,447%, which is more than 10 times greater than MSCI China, and actually 3 times better than the S&P 500. Now the problem is that China tech slice was 2% of the index 10 years ago. And that's literally why we created KraneShares, was to pull out that small slice of growth stocks and provide it as its own separate entity that investors, you could lose the slow, no-growth sectors and just focus on these growth companies. And why we think that's very important is because we believe that a re-rating of Chinese equities likely already started going back to January of 2024, when Chinese equities bottomed. And so we really do believe that as investors come back to looking at China, that they're going to focus on these growth stocks as opposed to energy and financials. And on the next slide, obviously we're known for KWEB, our flagship fund, both here in the United States and also in Europe. But actually KWEB is really, it's by far our largest fund in both markets, but we recognize that some investors are looking for a broader exposure than just Chinese. If you think about KWEB as just really a growth beta for Chinese stocks. In the US, we have KEMQ, which just applies the KWEB thesis and applies it to broader emerging markets. And certainly Morningstar data shows that for the year to date as well as in 2024, it's one of the top strategies, both active or passive, in terms of EM, active mutual funds and ETFs. We've obviously leveraging the very deep options market around KWEB. We provide an income solution, just monetizing KWEB's volatility by writing calls, and that's CLIP. We've done a buffered and principal protected versions of KWEB. And then more recently, based on what we see happening in terms of a re-rating of Chinese equities, we did levered versions of Alibaba and Pinduoduo. And then as students of index construction, it's kind of shocking to us that Mercado Libre the e-commerce giant in South America is actually not part of a lot of MSCI indices. Certainly for European investors, for UCITS, if an investor would like any of these strategies in a UCITS version, please let us know. But again, leveraging really our franchise around, we're known for China growth stocks versus K-Web, but obviously we have an EM version as well. Now, okay, let's dive in of why we think this re-rating of Chinese equities, which again, we believe actually started back in Jan 2024. More recently, since our last quarterly update, without question, the biggest news just back on July 1st was the highest echelon of the Chinese government had a meeting where they publicly announced an emphasis, a focus on trying to curtail overcapacity and price wars. And I think why that's important is that as students of Chinese capital markets and economy, we've seen numerous situations where these companies in China, in order to try to garner market share, end up entering into very, very fierce and bitter fights. If we think about Uber and Didi, almost bankrupted themselves in trying to be the leader in taxi cab hailing in China. This is very much, I would say, the antithesis of sometimes Western media almost makes it seem like the Chinese government anoints these industry leaders, if it's Huawei or BYD or Alibaba. That is the farthest thing from the truth. Those companies are the survivors of this ultra capitalistic situation of where these companies are fighting for against one another. And people will say, yeah, but a lot of global companies aren't allowed to compete. But an analysis would show companies like Yahoo were defeated in China. They left China because they couldn't compete. Companies like Google voluntarily left China because of an unwillingness to adhere to the local laws. And there are US and global companies succeeding in China. Costco, immensely popular in China. So you have to have an edge, and there are not these preordained winners. But the problem with that is that this ultra competition can mean you have situations where the companies, they might win the war, but it's a Pyrrhic victory because they might own the space, but there's no net income, there's no earnings per share. And what made this meeting on July 1st is it was immediately followed by a very prominent government media source on July 2nd said that the government was going to focus on this very seriously. And they actually named the industries they were going to focus on: solar, steel, cement, electric vehicle, and e-commerce were designated as industries where there was these price wars and or overcapacity, and the government was going to do something about it. Now, why that's important on the next slide is that China geographically is very large. It's a huge area geographically. And so the Chinese government is not like some sort of James Bond that it can immediately say, this is what's going to happen. That's patently false. You have a leadership at the top who then disseminates down policy. And it is the underlying bureaucracy, these government agencies on a province, on a municipal, on a city level are tasked with implementing that policy. Now that can lead to misinterpretation, to potential policy errors that this underlying bureaucracy has to interpret what the leadership is saying. And I think what's important is that upper echelon of the Chinese government was very, very clear on the industries and the issue. The industry, steel, cement, electric vehicle, e-commerce, solar. Those are the industries that were seen as having overcapacity and unproductive price wars. What are they going to do about it? Well, I think the first industry where we've seen this policy being implemented is solar. So on the next slide, now many of us know that China dominates solar manufacturing. The issue is that fierce competition has led to a price war amongst solar panel makers in China. And just recently, Longyi and one of their rivals, Tongwei, they actually just reported their preliminary first half 2025 results. Revenue growth was very strong. Both companies actually lost money. So even though they're the industry leader, they're actually losing money. And so on July 3rd, you actually had the MIIT, the Ministry of Industry and Information Technology, brought together the 14 largest solar companies and industry associations and said, this makes no sense that, yes, we're the global leader, but we're not making money. We're not making profits. And so it was agreed upon that there would be a 30% reduction in production. Now, I think for investors in the space, that gets us really excited because while Longyi and Tongwei and other peers in the space, we know just from their preliminary second quarter, first half results, they weren't very profitable. That, I think, very likely is going to change in the future. And so, yes, they have revenue, but now we're going to see these companies become more profitable. And I think this is where you start to connect the dots of who else accuses China of overcapacity in solar. The United States, as well as the European Union, the UK government. And so you can see how this addresses a domestic issue, but it also addresses a trade issue. And I think it also makes those companies more appealing for investors. Now already on the next slide, you can see this is the Guangzhou Future Exchange. They actually have a polysilicon future. Today, that future went up almost 6%. Over the last 10 days, it's up 17%. So you're immediately seeing this effect, and I think that's really, really important because again, it solves a domestic issue. It makes the stocks, it's going to make these stocks more profitable and therefore more appealing for investors domestically, globally. Obviously, for those in the US, we have our K-Green, our clean tech. But it also helps address a potential US EU trade issue. Now, on the next slide, we've seen a price war breakout in the restaurant delivery space. You can see Meituan and Alibaba have historically dominated restaurant delivery. Alibaba has a unit LME that competes against Meituan. But about a month and a half ago, JD.com, the leader in online electronic sales, really should be benefiting from the electronic subsidies in China. They decided that they were going to get into restaurant delivery, that they have their own delivery network. And they said, just makes sense. We have this huge delivery network. Let's deliver food as well. They also said we're going to get into online travel. And in order to try to compete against these established players, they said, we're just going to subsidize it. We don't care if we lose money. And it forced Meituan and Alibaba to engage in similar subsidies in the space. And that's, it's, as investors, those stocks have really underperformed KWEB LN and KWEB US, because while they might be able to garner more revenue, it's arguably potentially problematic for their bottom line. And in the case of JD, analysts are expecting a 42% decline in net income for Q2. For Alibaba, it's down only about 5% because obviously Alibaba's a much more diversified business. But again, the key is on last Friday, the State Administration for Market Regulation, SAMR, called the three companies in and said, nope, this is not good. It's not healthy, and it's bad for the industry, and it's arguably hurting other. If you think about restaurants, no one is going to go to a restaurant in China because your restaurant delivery is being subsidized. I mean, people are buying coffees and bubble tea, a dozen a day, because you can get it basically for free because these companies are in. So SAMR just last Friday said this is unhealthy. It needs to come to an end, and that's something that we hope certainly is fully implemented as quickly as possible. Now I know, Xiaolin, we're on the next slide. We're headed into some of the earnings season, and I know we're seeing that online retail sales have been quite strong. We had a good 618 event. I mentioned JD maybe has a little bit of an issue in terms of net income. Alibaba, obviously, a lot more diversified, buying a lot of stock back. But we also highlight Kuashu, and our daily research blog in ChinaLastNight.com. We've been writing about how well the online video companies like Kuashu, Bilibili, Tencent Music Entertainment are doing that. That some of our more medium-sized companies, I think, are going to be some of the Q2 surprise winners, Xiaolin. But certainly we're hoping that even though we had this very strong June sales event, we've seen online sales numbers look pretty good. Maybe for JD and Meituan, this price war unfortunately could show up in Q2 results. But for the rest of the space, hopefully we'll be able to navigate that. And we're just on the precipice of this Q2 earnings season. But I think Xiaolin, the bigger issue is just, is China addressing these overcapacity issues, these price war issues? Is that part of, obviously it's a very good thing for the domestic economy. It's a very good thing for, I think, for investors as these companies become more profitable. But on the next slide, is there something we can be gleaning from those tea leaves in terms of China historically has exported deflation. China, these price wars, this ultra competition means China's exported deflation. In China, we've had a little bit of a deflationary situation, and I actually think that might be ending. And I think the repercussions are significant because does that lead, when you combine it with U.S. tariff policy, are we heading into a cycle of higher inflation globally? Does that maybe make, if we're going to have some inflation in China, is that a disincentive for savers to put it in the bank? Because and that's where, Xiaolin, I know you have some thoughts just around, if we see some of this pickup in inflation in China, what effect would that have on savings?
Yeah, totally. I think, obviously China has been fighting this deflation for a very long period of time. I mean, no denying for that. Obviously, it has gone up to quite well in the scale quite significantly prior pandemic, right? Earlier or during pandemic period of time, and since then it has been really, in the downtrends. A lot of discussion is China exporting all these to the rest of the world. I think the intention was for China to focus its own domestic first and what they do from here. Obviously, with where the inflation is, that gave a lot of flexibility for central bank in China to do as much needed as they could to accommodate in the monetary front to boost this economy. Obviously, did a few rounds of cutting interest rate. I lost how many rounds they've been doing cutting rates for China domestically to encourage spending as one, also lowering borrowing costs for corporates, and obviously to kind of like encourage a bit of a take out of liquidity from household and corporates. We do see pickup in picking credits in recent months. Obviously, not to the level just yet that the government would like to. But then, on the inflation and the overcapacity, Brandon, you touch base on this, on this China's, trying to deal with overcapacity in the green space. And this is really where we just put them here to say, China also trying to help, with these issues on the next page on overcapacity, also the anti-evolution to kind of help both the domestic and EU issues that they have been, needing to do and to help with. Obviously, I think certain consolidations are needed. Certain consolidations are helpful, and also it is long needed. And also we put a chart here. I nearly forgot is really the bond market. In the past we favor really the bond or the stock purely because of high yield. I remember talking to someone, you probably laugh this, but a long time ago, it's like a few years ago when we go to China, did you guarantee me a return of 5%? Why not? Because they put money in their bank account for 1 year fixed is 5%. They would naturally ask you for that. Obviously, that has been cutting down dramatically in a massive way. Now, the 2 year fix is probably just 1%, slightly over 1% today. Make the bond and everything is less attractive. Also, the stocks market has gone through a huge period of consolidation, purely from macro-driven of headline news dominates. It is the time that a few things will have to prevail in the near future. One, the earnings, obviously, some companies may have a tough earnings, but they are all climbing back, if not exceeded their pre-pandemic level of profits and earnings in some of the corporates, which is hugely undermined and underlooked by a lot of investors in the market on Chinese stocks. That's one. Second, the resume IPO market. Just in Hong Kong itself alone, Brandon, I know you write this extensively in your CLN notes every day, was 52 stocks already, but 120 plus billion Hong Kong dollars raised for just those new IPOs, and there's 200 new IPOs in pipeline. We think this market, in the stock markets, not only fundamentally very attractive valued, that is hugely undervalued per their earnings today where they deserve. Also, there's a healthy pipeline to continue to come in the stocks market, make the stocks markets really, very attractive to look at it as a stock. Obviously, we recommend and we suggest you should be very selective. It's not everything is out of the woods yet. Okay.
Yeah. And I think, Jillian, I've thought, if we see this pickup in inflation, if China is no longer going to be this exporter of deflation, if addressing this overcapacity and price war issue leads to some inflation in China, that becomes a headwind for fixed income investors, for just putting your money into the bank, I think, bank account. It could also allow these companies in China to become more profitable, therefore more appealing to local investors. And so I think you see this numerous knock-on benefits of just a little bit of a pickup of addressing this domestic issue. It actually could really benefit the domestic stock market. It could divert money from going into bank accounts, going into the bond market, because stocks are going to potentially look a little bit more appealing. And then at the same time, it addresses some of these issues that have really been, I think, at the heart of some of the U.S. and EU trade talks with China. And I think that's where on the next slide we show that, it's kind of like a little bit of a mosaic theory, wouldn't you say? Of like trying to read the tea leaves, so to speak.
Yeah, totally. I think overcapacities and things like that in certain sectors. I don't know, Brendan. I somehow felt a bit of a consolidation is needed. You don't need 250 car makers all producing electrical cars. And then clearly there's leaders and consolidations are needed and happening in that sector at the moment, which you want to see and you want to continue to see. And the leaders are continue to grab the market shares internationally, which I see. To be honest, I live in London. A few years ago, I don't see much Chinese car maker in electrical cars outside on the streets. But now you drive around, you see BYDs everywhere. Okay, it's a huge step forwards for the Chinese car makers breakthrough in European markets. They have a warehouse, a big setup in Amsterdam, in Netherlands, now in UK. All of them are coming. BYD, NIO, I know they are coming. I got the great pleasure to get to know, Mr. Li himself from Li Auto. He was studying at Tsinghua University. Then I got to know him, and he was, telling us how ambitious his plan is also to go internationally. I mean, somehow I felt like overcapacities is an issue in certain sectors because the trend is happening, but also in certain sectors is proved to be a leading and force for competitions and to be more competitive. For instance, in the innovation space, you've been to China 4 times already this year, right? And then many conferences you attended or others attended. I heard the feedback is AI, innovation, technologies, all the topics in every single conference. You go to China, is the majority and it's the dominant topic happening in China. We can't deny there's a lot of companies in all these areas in the innovation, AI, robotics. I'm going to steal my page in a few pages later. It's all happening today, and you want that. But in the more semi-matured industries, you should deal with overcapacity to remain competitive, and if not, to consolidate and continue to internationally expand. Brendan?
Yeah, 100%. I think, there's a domestic argument for what China is doing addressing these issues, and then it certainly plays into the potential for a Trump-Xi summit. That many of these issues on the next slide, that I just think that a lot of the issues that China is addressing domestically really do play into some of the negotiation that's taking place. Obviously, just today, U.S. Treasury Secretary Scott Bessent said that he's going to be going to Stockholm to meet his Chinese equivalents, his counterparts. And I think the underlings meeting is really to, coordinate and build the base for a Trump-Xi summit. It's been our belief that in China, there's going to be a big celebration of the 80th anniversary of the end of World War II. And we know that President Xi, when he was at the APEC conference in San Francisco back in 2023, he spoke about the U.S.'s role in ending World War II, and particularly the role of the Flying Tigers. And our founder, John Crane, and former ambassador to China, Terry Branstad, met with Harry Moyer, one of the original World War II veterans, one of the Flying Tiger pilots. So I think you'd say there's an opportunity. At the same time, there's opportunities at the APEC conference will be in South Korea in October. You also have the G20 conference in South Africa in November. So just kind of, again, mosaic theory, kind of reading the tea leaves, you'd say there's been a lot of interaction between the two sides. Just a stark contrast to the previous administration, where there was no dialogue, there was no conversation. And it's been our belief that Donald Trump, as a business person, corporate voices have a voice in the Trump White House, something that was arguably was not occurring under the previous administration. So just, obviously we can't predict the future. We would just argue the odds for a U.S.-China trade deal under a Trump administration are looking strong, and certainly that geopolitical overhang, Xiaolin. I mean, on the next slide, you've actually been able to quantify what that means.
Oh, yes, totally. I mean, this is an interesting page, and you would expect the other way to happen because given the market performance, obviously how resilient from a macro perspective, the Chinese economy has proved to be in this quarter. With all the headline news, you would expect, everything would be in a quite challenging situation. But thanks to their domestic policy supports, we see a very resilient economy, very resilient stock returns, Chinese stocks actually outperforming. But at the same time, you would have hoped, with April's developments, May and June's developments with the talks happen in Geneva and in London subsequently, you would expect investors to start to tip their toe in it, which they are. This is the basically a snapshot of the 335 active global funds with obviously we have the title here, they combine have 1.2 trillion assets in management, but their exposures to China. The left side charts is showing their exposures versus their broader benchmark. You can see broadly speaking, all of them are underweight to China at the moment. Obviously, the underweight trend has been reducing. That's a good sign that the market is recognizing, this asset class is stabilizing. There's opportunities here and there, and they started to allocate, which at KraneShares, we have a huge benefit of seeing this trend happening. I'd say our fund, thanks to your trust, that reflects the underweight, hence the flow to this asset class. But we still think it's a huge room to go for the investor to close that gap. If you look at the percentage of the fund of all these 335 funds we just mentioned, how many of them in percentage of these funds are invested in China? There are a significant number of funds are not invested in China, means zero allocations altogether. So just think about it. Headline news is headline news. You really need to dedicate it, look through the events, knowing what is happening, what is domestically doing, why they show resiliencies, what other supports are there, and the corporates actually are doing well. We didn't touch base on this in this quarter's webinar, but Brendan and I often bring this chart to you is the corporates buying their own shares. If you believe in your own stocks, put your money where you believe in, which is what the Chinese corporates are doing. Okay, we believe in our stocks, we buy them back, which is all they're doing. Fundamentally, they are getting better. They go back to pre-pandemic, if not exceeded. Valuations are very attractive, hugely underweight and owned. If things start to turn around, to flip, which we are expecting, the deals and everything are talking now, at least we see the lights at the end of the tunnel. If you go to the next page, this is simply to say, you know what, this is your benchmark of where your China allocation should be, and this is where you are. Simply, if you think of like what we happened, Brandon, what was that? Was the deal announcement of the H20 chip from Nvidia, then came up on itself one day, boom, 5%. The whole basket of stock gone up by 5%. That kind of re-rating can happen just like that. It's a lot of clients are asking Brendan, asking myself, say, hey, can I just be tactical, be cute, timing to the market? No. Okay, this is really a strategic allocation. You need to have a leg in at least most of the time to know you are exposed to this asset class. When the re-rating happens of the stocks, it happens very, very quickly. It's not easy to time in this market, particularly when they are so fundamentally cheap valued. The rebound can be massive in the scale that would be too quick for anyone to catch. So this is where we just show you if any of the weights in these broader indices start to re-weight, you have a massive room to catch. Obviously, they peak in 2021. This is right, in the middle of pandemic relaxation. We don't think today's situation is anywhere, as bad as that. So the percentage of what we should own China should be multiples from what today's level is. And if you go to the next page, Brendan, I'll just finish up one more page and I'll pass it back to you. This is the AI. We see a new wave of momentum, especially in robotics and AI happening in China, with a standout breakthrough of emerging just like this quarter itself. I just give you a few examples. I apologize if you know the names already. Unitree, for instance, Unitree Robotics became the world newest unicorn last month, closing a Series C funding round that puts their valuation to $1.7 billion US. This financing was, led by some biggest names in the industry: Tencent, Alibaba, and Geely, all these big names. By the way, the headquarters in Hangzhou, they are a Chinese company. They heavily advanced in China robotics sectors, and then now they are preparing for the IPOs. They have rapidly scaled up, both like quadrupled and humanoid robotics developments. And also the rise in the humanoid robotics offers a real solution. It's not just talking about ideal world. For instance, to help with the demographic pressures and labor shortage in China. With China now aging populations top of the mind and similar to the trends that you can see globally, affordable and you can do multifunction of humanoid robotics is hugely needed. People love that in healthcare, in public services, service sector. Unitree's products is amazing because they made them available to purchase. Also, the cost is so reasonable. Today, they undercosting a lot of the Western competitors. One robot is somewhere around 16,000 US, give or take. I say is available to purchase and being adopted across education, R&D, facilities, inspectors. I think, this robotics revolution is really underpinned by a powerful synergy. Obviously, U.S. leaderships in the AI model paired with China's, dominance in manufacturing, hardware, and scaling. I think the next generation of industrial and humanoid robots will go mainstream. We will see, obviously, China's ability to commercialize and mass produce this complex technology much faster, and see how effectively they can make them available anywhere. So I think looking ahead, you can see it was very recent announcement NVIDIA will sell the H20 AI chip to Chinese customers. Thanks to this newly granted export license, I think now this could or significantly accelerate these trends. I think the chips now designed to meet to give all these Chinese robotics and AI companies a much needed access to a bit of advanced hardware so they can further develop their R&D and the real world. I think with the combined force of breakthrough AI models like DeepSeek, ambitious companies such as Unitree, and now renewed access to the top tier chips, we really anticipate China's innovation engine in AI and robotics will only continue to pick up speed in this quarter and the quarters to come. I'll pause there, Brendan. Too much excitement on the AI innovation. May we maybe close? I hand it back to you for maybe
Sure.
the key takeaway for the quarter on the next page.
Yeah, I mean, since January of 2024, when Chinese equities bottomed, KWEB is up just over 50%, beating the return of the Nasdaq by more than 14 percentage points, beating the S&P 500 by 21 percentage points. And yet Chinese equities remain underowned, underloved, and yet in an uptrend. As some of our good friends like to say, we think that the geopolitical narrative continues to weigh on investors allocating to the space. Just today, 61% of turnover in Hong Kong was generated by investors in China through the Southbound Stock Connect. All indications of the under ownership of Chinese equities, despite this very strong performance on an absolute and relative basis. It's our belief that there are signs that a potential U.S.-China trade summit with President Trump and President Xi meeting, potentially there's signs that that summit could happen in the months to come. And would that alleviate this geopolitical overhang? At the same time, we're very much encouraged by the Chinese government looking to address overcapacity and price wars. We believe that those policies, as they're implemented, will have significant benefits to us as investors in those companies as those companies become more profitable. At the same time, we recognize how addressing this domestic issue could play into that U.S.-China trade deal that China addresses overcapacity concerns, not just with the US, but with the EU as well. At the same time, for all investors, it shows why investors need to have a China partner, because as China potentially stops being an exporter of deflation, that could have serious implications for investors and their inflation outlook, especially when combined with a US tariff policy. But again, it could also stop this deflationary spiral we've seen in China. And certainly that could actually be another tailwind for Chinese investors to divert savings, not to bank accounts, not to the bond market, but to China's stock market. And again, as we'd be beneficiaries of that pivot. So net, we see a number of positive catalysts. We don't pretend to be able to predict the future. We can't say definitively that this trade summit will occur, though, again, we would argue there are signs, there are subtle signs taking place, using a mosaic theory or reading tea leaves. And regardless, we see some positives of this new they're calling it the anti-involution campaign in China. And we're already benefiting as investors in the China clean tech space. Certainly looking forward to further strides in the e-commerce and restaurant delivery space. And again, we hope to earn that partnership role with investors as we navigate these issues and opportunities in the weeks, months, and years to come. We're going to love to have any questions from the audience. If you're joining us on KraneShares.com, please email us at info@KraneShares.com or using the Q&A button. Happy to answer any questions, or certainly, as always, if you'd like to receive the PowerPoint, please email us at info@KraneShares.com. And just to reiterate Xiaolin's message, if you're looking for CIMA or CFP credits, please email us at ce@KraneShares.com. That's Charlie Edward at KraneShares.com. And certainly happy to engage in any questions. Xiaolin, I actually don't have access to the question, so I'm gonna have to defer to you're taking a lead on this one as we go through our compliance slides.
No problem. We did have early on during the presentation a question that asking us to explain the price war between the delivery company, which you addressed already. So that's one we addressed already. And we have a few more questions, so please continue sending your questions. Brandon and I will answer them as many as we can. There's one question, literally this is a discussion that we heard back a while ago, I think particularly during pandemic, and as soon as when the later part of the pandemic lockdown was when a lot of the manufacturer move out of China to Vietnam and Indonesia and India, and its impacts on China's economy. I have my answer, but do you want to give a go?
Yeah, I was just thinking, actually, Xiaolin, we actually have a Unitree robot joining us later today. We're going to try to bring it on to a media opportunity.
All right.
We'll be on Fox Business later on today during U.S. hours, but we'll try to get that video up on the website and on Twitter. But yeah, just made me think when you're talking about the opportunity set in the humanoid robot stage. There's nothing like seeing this robot in person. I know we're looking forward to bringing it to London in a few months. But yeah, the question was more around. Do you mind repeating the question? I apologize.
China's manufacturers, or the manufacturers used to be in China, then they moved out to Vietnam, India, and Indonesia. What is the impact on China's economy?
Yeah, I think there's you have a bigger picture issue. Like I always like to say, I'm wearing my Costco undershirt from Kirkland, as the Costco brand, and unequivocally, that T-shirt was manufactured in Shenzhen, China, a decade ago. Today, that T-shirt's made in Bangladesh. That due to the rise of Tencent in Shenzhen, you know, the social media and mobile payments company, certainly the rise of and just the knock-on effects in terms of technology hub in Shenzhen, but also you then have obviously BYD's based in Shenzhen, the big electric vehicle and hybrid automaker. That these low-end clothing manufacturers have been pushed out of Shenzhen, and so some of the very low-end, unsophisticated manufacturing, such as low-end clothing manufacturing, like my undershirt, has gone to where labor costs are significantly less than China. Some of that high-end clothing manufacturing, like Nike and like iPhone, still, it's not just about lower labor costs, but having skilled labor. Some of that is still in China today. But I think the China plus one strategy has actually been driven by Chinese manufacturers that during COVID, what was viewed as a supply chain problem was really a revenue problem for Chinese manufacturers. That when the Chinese government closed the port of Shanghai, they couldn't get their goods to their biggest clients. So by diversifying their manufacturing base to places like Vietnam, Indonesia, Malaysia, if there was ever a similar situation, they've been able to diversify. So Chinese companies are the real culprits behind the China plus one strategy. And I think that's something that's really missed by a lot of investors. You know, what was our supply chain problem was their lack of revenue problem because they couldn't get their stuff to their biggest clients, which is why they've diversified globally. And just, you know, if you look at BYD, plant in Hungary, Turkey, and Brazil today. So they want to be able to make their electric vehicles and hybrids regardless of what's happening in not just I think they have about 10 factories in Shenzhen, not just in Shenzhen, but across China. So yeah, it's something that, you know, that know-how, that skill set in high-end manufacturing is not. It's something that is been developed over decades. So it's not a skill set that can be easily replaced.
I'd agree. Given the time we have, I'll regroup a few questions together for us to answer them all together. I mean, some of the questions are centered around the political structures and the systems in China. A few questions around how stable Xi's government is. You know, there are some rumors about his health and relationship with other elderlies and how reliable this, China's political machine is.
Yeah, I think it's historically China's always been run by a bureaucracy. If it was the place is just too darn big. It's impossible to think that one single person can control that scale of geography and population. So the real mechanism is this bureaucracy from a regional geographic, all the way down to the town or city government. And so that message is disseminated on high. And again, I think we've seen where there can be policy misinterpretation, but I think what we're seeing is a very explicit policy around addressing these price wars and overcapacity.
Yeah, and also say this is his second year of his third term as a leader to the country, at least feeling or compared to the last two terms that the language, the agenda set by him from top down level has been nothing but in the third term is very economic friendly. The language you hear, the policy centered around, even in each of the statements you follow yourself with different conferences, statements come out of that. It's all centered around how they're going to help with the economy. I think he's back on the center of focusing on growing the economy, helping creating wealth for the country. If that was the agenda, that was which it is for all these things we have been hearing over the last period of time. I mean, this would actually increase the confidence from the people, from bottom up, to support him continue as being a leader. So hopefully that's continue. Obviously, we watch them very carefully with all the announcements and everything. We are right on time. I'll just try one more question. Maybe Brandon, let's squeeze in one more question. I think it's from Jim asking, what is the impact of the declining dollar value on China stocks or Chinese stocks and ETF price?
Yeah, I think part of this American exceptionalism, this significant outperformance, I mentioned from the global financial crisis low, the S&P 500 is up just about 1,200%. Part of what's aided that performance is that the US dollar index since April of 2011 to its high went up 56%. That there's a 10-year period where the US dollar outperformed all 100, there's over 100 currencies globally. Not one of them beat the dollar over that time period. But since that high, where the dollar went up 56%, it's declined 14%. And so the dollar has been a huge tailwind for US equity investors, and now that's become a tailwind. Historically, even though a lot of, obviously, the KWEB companies are either denominated in US dollar or Hong Kong dollar, that's denominated, which is pegged to the US dollar. Historically, those underlying companies, because those underlying companies and their revenues are predominantly based in China, they're kind of renminbi, that historically we have an inverse relationship to the DXY in terms of KWEB's performance, that if the dollar is weakening, if the renminbi is strengthening versus the US dollar, that means those underlying companies are worth more. So we historically have a little bit of an inverse, and I do think that the dollar is probably a bit oversold here, that maybe the Fed isn't going to cut immediately, but when they do start cutting again, that should weigh on the dollar again. And if you're a euro-denominated investor in U.S. equities, you're negative year to date. The same is true in yen, Japanese yen, or Singapore dollar, or Taiwanese dollar. And I think you combine that with concerns of the U.S. budget deficit, the potential rise of bond vigilantes, as well as just some of the bipartisan politics in the U.S. We've actually have this, the two sides have to do a budget deal in the coming weeks. And yeah, I think some of these factors are part of why we see a little bit of a global rebalancing away from U.S. equities. I'm not arguing foreign investors are taking their U.S. stocks to zero. I'm just saying there's arguably some money in motion in terms of rebalancing, and some of that, I think, when it makes its way back in the Chinese equities, it's going to go to these growth stocks like we have in KWEB. I know that's self-serving and highly biased, but I just don't see people being interested in Chinese energy stocks or Chinese financial stocks. I think they want these growth opportunities that KWEB captures.
All right, Brendan, that's all the time we have. I know some of the questions we didn't get the time to address. Feel free to send us an email at info@KraneShares.com. Brendan and I will get back to you on those questions it's not addressed today during the live session.